And let me welcome you to Closing Bell. I'm Scott Wapner, live today in San Francisco. That was the Fed chair, of course, following what many describe as a hawkish pause by the central bank. No increase in rates, but the outlook, which the markets were waiting for, shows holding them higher and more restrictive and keeping them longer there than perhaps anticipated. And with that, fewer cuts than the market has priced in for next year as well, perhaps because they also raised their economic outlook for next year, which Chair Powell talked about. He said, quote, the economy remains robust, GDP growth higher than expected. Labor market, he says, still tight, but coming more into balance. He also said, this was interesting, at least 5 times, perhaps even more than that they will, quote, proceed carefully, but would raise rates again if necessary. He said, based on the outlook, it was, quote, more likely than not that they'll raise at one of the 2 remaining meetings. Also wouldn't call a soft landing a baseline scenario, but that it was still possible. He did call it the primary objective. Joining me now to discuss all of this and what happens in the markets now is a CNBC exclusive interview. It's DoubeLine's Jeffrey Gundlach with us, as always, as he always is on Fed Day. Jeffrey, welcome. It's good to talk to you today.
Nice to be back again, Scott.
Yep. What's your big
press
takeaway?
Conference today.
Yeah, it sure was.
You nailed it.
What is your takeaway from it?
You nailed it with your intro. That's what I was going to say. The word of the day is carefully. He said it 2 or 3 times in his prepared statement, and he said it many, many times in the Q&A. I think there was something in there for everybody. I think this is really one of the best Fed decisions that we've had in a while. I think that carefully concept is wrapped around the idea that we've raised rates 525 basis points. He pointed that out in his statement. We continue to do QT. With Stephanie Link, I think prior to the Fed decision, I think correctly pointed out, doesn't get enough play, that QT continues to happen. So, they did upgrade the forecasts for next year. Unemployment not as bad. Economy a little bit stronger. So I think he's right about all this. I think that it's the right thing to not raise rates. I think it's the right thing to wait. We have a lot of indicators that are looking at softness. A lot of people are making a big deal about the consumer resiliency. I think a lot of that's due to high prices. And you see that in credit card gains. There was a big drawdown a couple months ago, but it's back up. So we see a lot of debt in the economy. And another problem with the economy is there's been so much increase in interest rates for the Federal Reserve and the Treasury Department. In other words, the interest on the debt is really going up a lot. And it's going to go up every month that rates stay at this 5.25 to 5.5 level, and obviously go up faster if they do another hike or 2, which they're certainly contemplating or have the door open to. We've already had hundreds of billions of dollars of increased interest expense, and it's going to go up a lot more with these interest rate levels. And it's creating a lot of bond supply. And the bond supply has been one of the reasons interest rates have been going up, in addition with the quantitative tightening. The good news, I guess, on interest rates is at least taxes are going to get paid here in California on October 15th. One of the reasons the deficit is so big is there's been deferral of tax payments. That's going to go away. In fact, it's going to get a lot worse because here in California, we're going to have to pay 2 years' worth of taxes unless they change the rules for the 2023 tax payment and push that forward from April 15th. We'll have October 15th, 2023 and April 15th of 2024. That's 2 years' worth of taxes paid in 6 months. And I know that some people, are prudent and plan for that. I know I have. But a lot of people, they adjust their lifestyles. And that has to do also with a headwind on the student loan payback. Because we know a lot of people, when they weren't paying their student loans, they spent the same amount of money, or they borrowed money, they paid the same amount of interest by ramping up their credit cards. And that's certainly been the case. So we have a lot of cross currents right now in the economy. I kind of see it in a transition. And the data is extremely non-reliable right now because of all of these distortions from the government money and now the payback of, and now the drawdown in those excess savings, now the payback of loans. And now we have these strikes showing up. So we have cross currents regarding the inflation situation that it makes it very prudent for the Fed to have a wait-and-see attitude. These strikes are obviously inflationary. The oil price going up 30% since June is obviously inflationary, right? So all these things are happening. But at the same time, the shelter component of the CPI is definitely coming down. The owner's equivalent rent lags badly. If you look at the Zillow and apartment list rent roll indices, they lead the owner's equivalent rent or the shelter component by about a year, and they're basically flat year over year. So a lot of cross currents going on, and it's absolutely appropriate to wait and see for the data. So they did the right thing.